The Bank of Canada is about to bring the pain. Or I guess more precisely, everything they've done over the last 18 months is about to bring the pain. Because as we go into the September 6th interest rate increase, or should I say rate decision? No, not an increase. Not an increase yet. It might not be an increase, but as we head into the September meeting, surprise data has now shown that the Canadian economy is slowing. Bank profits are way off, which includes some layoffs for some bank employees. And Canadian premiers are reaching out directly to the Bank of Canada governor in order to ask him to maybe settle down a little bit and think about the human costs of more rate hikes. But before we get into the details and what this means for the Canadian economy, do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. And don't forget, you can still get my new book, Mortgage Secrets, from mortgagesecrets.ca, totally for free. All you have to do is pay the shipping and handling. And if you've got a mortgage coming up in the next 3 months, 6 months, a year, 5 years, well, it's probably going to be a pretty good tool to have in your arsenal, as it talks about the secrets of how to get a lower interest rate, which I'm pretty sure is something all Canadians could use right now. Okay, so sorry, I know it's been a minute since I posted a video here. I went on a little family trip with my family while I still had a chance, because these Bank of Canada increases are now starting to filter their way through the economy, and we're all starting to feel a little bit more pain. But that being said, I guess there is some good news here. Well, I guess it's good news depending on how you look at it, and that's that the Canadian economy is slowing, at least according to Q2 numbers from this year. GDP numbers came in at negative 0.2%, which was widely unexpected, which means that the Bank of Canada now at least has a case for not increasing interest rates, although they still might do it, and I'll get to that a little bit later in the video. But this is a double-edged sword, because you're either hoping that the economy slows and there's no more interest rate hikes, or you're thinking about this from the perspective of, oh no, the economy is slowing, and that means there could be some bad news on the horizon for many Canadians. And unfortunately, that is what is about to happen as the Bank of Canada's actions from the last 6 to 12 to 18 months starts to be felt within the economy. And we're seeing this most notably in the third quarter profit results from Canadian banks, as pretty much every bank reported lower than expected profits. And this has led to two major outcomes. The first is CIBC, for example, tripling their bad loan provisions. So in other words, they are preparing for more loan losses, they're preparing for more defaults, and ultimately what that means is that they're preparing for more Canadian businesses and more Canadians in general not to be able to make the payments on their loans. Now, in addition to that, we're seeing other banks like RBC warn of more job losses. So RBC, one of the most profitable banks in Canada over the last couple of years, reduced their workforce in the last quarter by 1% and are expected to decrease it by a further 1% in the coming months. So what this means is that Canada's most profitable companies are now looking to eliminate jobs. And this is largely due to higher interest rates, which means lower profits for the bank, lower growth in the economy, and in general, an expectation from investors of not just banks, but pretty much every other publicly traded company that it is time to start cutting expenses. And when you need to cut expenses fast and significantly, the way that that gets done is through employment. And I'll link to a video about how the Bank of Canada is going to kill employment that I did in July a little bit later on in the video. But as we start to see the most profitable companies miss earnings and start to cut jobs, that means that there's going to be a filter through effect to the rest of the economy. So the idea of a soft landing is no longer a soft landing. In fact, it is widely expected that we are going to feel a mild, if not moderate recession now that the pain of the interest rate hikes is starting to be felt throughout the economy. And this leads to Canadian premiers Doug Ford and David Eby pleading to the Bank of Canada governor to please stop with rate hikes, as they see more and more of their provincial voter base start to feel the effects of, again, these higher interest rates. Because obviously we're all feeling the pain, whether you're a renter and experiencing higher rents, you are a mortgage holder and experiencing higher interest rates, or you are a fixed rate borrower who, by the way, isn't necessarily feeling the pain right now, but is about to in the next 2 to 3 years. Now, that being said, any attempt by the premiers to stop the Bank of Canada from doing what they need to do in order to get inflation down would be dangerous. So don't expect that Tiff Macklem is going to read Doug Ford and Dave Edby's letters and go, oh my God, you're right. There is a human cost to this. We need to stop. Because quite frankly, the Bank of Canada governor doing anything that is suggested by any politician would lead to a significant reduction in the confidence that the Bank of Canada holds, not just from Canadians, but also from other economies around the world. So don't expect that these premiers actually have a voice in what's going on. Now, that being said, the Bank of Canada is of course looking at the human costs associated with the higher interest rates, and they were trying to find a balance. And that's why Goldman Sachs is saying that the Bank of Canada is probably going to skip an interest rate increase this month, but will do one final rate hike in October. Now, many other economists are suggesting that the rate hikes are over, but that being said, some are still suggesting that you should prepare for possible rate hikes, and I would absolutely suggest that this is prudent. If you have either a fixed rate mortgage or a variable rate mortgage with a fixed or an adjustable rate payment, you should absolutely be preparing for a 0.5% to a 1% increase at the bare minimum. Now, not saying that that will happen, but you need to expect the unexpected, especially in an environment where the momentum is clearly on the side of rising interest rates. But that being said, thanks to the positive, negative job numbers, which basically indicated that jobs were being lost in the US, and the GDP numbers in Canada, it looks like the expectations for interest rates in the long term are starting to go down. If you take a look at what's happened in the last couple of weeks in the Canadian bond market, which is the market in which mortgages are priced off of in Canada, you can see that bond yields have come down significantly. And this is largely a sign that the markets are predicting that interest rates aren't going to go up as fast as expected or as much as expected. In fact, there is some evidence to show that interest rates could start to come down sometime in the next 12 to 18 months. But keep in mind, every forward-looking forecast is just that, a forecast. It doesn't necessarily mean that that is what is going to happen. It is the best guess at the time that the forecast is made, usually with data that is slightly out of date from the time in which the forecast was made. So you cannot rely on any single economist's predictions, you cannot rely on the Bank of Canada's forward-looking forecasts, and any prediction with respect to where interest rates are going to go is a guess. So then the question is, what do you do as a borrower? What do you do as a future home buyer? What do you do as a Canadian who is concerned about where interest rates are going to go? Well, there's a couple things you should be doing. The first is not to expect the worst, but to prepare for the worst. Anytime you're looking at mortgage calculations, rent calculations, cost of living calculations, always do so with the expectation that things are going to get worse before they get better, and plan for that. And if it doesn't happen, because you've planned for it, you should end up with some extra dollars in your pocket. If you're a mortgage holder or you're looking at getting a mortgage in the future, you can use the mortgage calculator that I've linked in the description below in order to run different scenarios showing what would happen if interest rates were to go up further or if they were to come down. And then if you're partnered up, I would talk with your partner about their risk tolerance versus yours, and always err on the side of the person with the least amount of risk tolerance. So in other words, the one that's most scared of the bad things that could happen in the economy. But here's something that I want you to remember. No matter what happens, even in an absolute worst case scenario, you're probably not going to die. In all likelihood, if you haven't spent way more money than you have, you're probably still going to have a house over your head. A roof over your head. And you'll probably still have all of your family intact. And those are the most important things. Not how much your house is costing, not how much your mortgage has gone up, not whether or not you're employed or not employed. What's important is the people around you and the fact that you will continue to survive no matter what happens with the economy. So keep that in mind as you watch the news over the coming months and as you see more reports of job losses and lower profits from companies and higher interest rates or lower interest rates or whatever happens. The most important thing you can do is not pay as much attention to the news and be happy with the things that you have control of, which a lot of that has to do, at least from a financial perspective, the habits that you create now and the actions that you take. Oh, and by the way, if you want to see that video on the Bank of Canada and what they're about to do to employment, and it's starting to happen now, make sure you check out this video right here.